Introduction. In accounting, business transactions are first recorded in the journal in chronological order. However, the journal records transactions date-wise, which makes it difficult to know the complete position of any single account. To understand the effect of transactions on each account, the entries recorded in the journal are transferred to the ledger. The ledger groups transactions account-wise, helping us determine account balances and prepare financial statements. This lesson explains the concept of ledger, posting of journal entries, and balancing of ledger accounts. What is a ledger? A ledger is the principal book of accounts in which all transactions relating to a particular account are recorded in a summarized and classified form. Each account has a separate page or section in the ledger. For example, all cash transactions are recorded in the cash account. All transactions relating to a creditor are recorded in that creditor's account. All purchase transactions are recorded in the purchase account. All sales transactions are recorded in the sales account. Thus, the journal records transactions date-wise. The ledger records transactions account-wise. The journal answers, what happened on a particular date? The ledger answers, what is the total effect of transactions on a particular account? This distinction is very important for examination purposes and conceptual clarity. What is posting? Posting is the process of transferring the debit and credit aspects of each journal entry to their respective ledger accounts. When an account is debited in the journal, it must be debited in the ledger. When an account is credited in the journal, it must be credited in the ledger. Posting ensures that every debit has a corresponding credit. Each account shows its complete record. The balance of each account can be easily calculated. The trial balance can be prepared. If posting is not done properly, the entire accounting system becomes inaccurate. Structure of a ledger account. A ledger account is divided into two equal sides. Left-hand side debit side. Right-hand side credit side. Each side contains the following columns: date, particulars, journal folio, amount. Entries on the debit side begin with the word to. Entries on the credit side begin with the word by. These words only indicate the side of entry. They do not have independent accounting meaning. Balancing of ledger accounts. At the end of the accounting period, each ledger account is balanced to determine its closing balance. Steps for balancing. Total the debit side. Total the credit side. Find the difference between the two totals. Write the difference on the smaller side as balance carried down. In the next accounting period, bring the same amount on the opposite side as balance brought down. Important rule: balances of real accounts and personal accounts are carried forward to the next period because they represent continuing balances. Balances of nominal accounts are not carried forward. They are closed by transferring their balances to the trading account or profit and loss account. This rule ensures the correct calculation of profit for the accounting period and proper application of the matching principle. Advantages of ledger. It groups all transactions relating to one account at one place. It helps in determining the balance of each account. It makes preparation of trial balance easier. It helps in detecting errors. It provides complete financial history of each account. It forms the basis for final accounts. This makes your answer more theory complete. So let's study the process of posting through this example. Journalize the following transactions, post them in the ledger and balance the accounts. On 31st December, X started business with a capital of 20,000 rupees. 2. He purchased goods from Y on credit 4,000 rupees. 3. He paid cash to Y 2,000 rupees. 4. He sold goods to Z 4,000 rupees. 5. He received cash from Z 6,000 rupees. 6. He further purchased goods from Y 4,000 rupees. 7. He paid cash to Y 2,000 rupees. 8. He further sold goods to Z 4,000 rupees. 9. He received cash from Z 2,000 rupees. Journal entries of the given transactions. 1x started business with capital 20,000 rupees. Cash account debit. To capital account. Cash increases, so it is debited as increase in asset is always debited. Capital represents the owner's claim and is treated as a liability of the business under the business entity concept, therefore, it is credited. 2 goods purchased from Y on credit 4,000 rupees. Purchase account debit. To Y's account. Purchase is an expense and therefore debited. Y becomes a creditor, liability increases and is credited. Cash paid to Y 2,000 rupees. Y's account debit. To cash account. Liability decreases, so Y's account is debited. Cash decreases, so it is credited. Goods sold to Z on credit 4,000 rupees. Z's account debit. To sales account. Z becomes a debtor, asset increases and is debited. Sales is income and therefore credited. Cash received from Z 4,000 rupees. Cash account debit. To Z's account. Cash increases and is debited. The value of the debtor decreases, therefore, Z's account is credited. Further goods purchased from Y 4,000 rupees. Purchase account debit. To Y's account. Expense increases and is debited. Liability increases and is credited. Cash again paid to Y 2,000 rupees. Y's account debit. To cash account. Liability decreases and is debited. Cash decreases and is credited. Further goods sold to Z 4,000 rupees. Z's account debit. To sales account. Debtor's value increases and is debited. Income increases and is credited. Cash received from Z 4,000 rupees. Cash account debit. To Z's account. When payment is received from Z, the debtor's balance decreases and is credited. Cash increases and is debited. Ledger analysis. Cash account, nature, real account asset. Total cash received. 20,000 rupees as capital introduced. 4,000 rupees as received from Z. 4,000 rupees as received from Z. Total is equal to 28,000 rupees. Total cash paid. 2,000 rupees paid to Y. 2,000 rupees paid to Y. Total is equal to 4,000 rupees. Closing balance is equal to 28,000 rupees to 4,000 rupees is equal to 24,000 rupees. Since the debit side is greater, 24,000 rupees is written on the credit side as by balance carried down. In the next period, it appears on the debit side as to balance brought down. This balance appears under current assets in the balance sheet. Cash normally shows a debit balance because it is an asset. Capital account. In the given transactions, X introduced capital of 20,000 rupees in cash to start the business. Journal entry. Cash account debit 20,000 rupees. To capital account 20,000 rupees. When posting to the ledger, cash account is debited. Capital account is credited. Since there are no drawings or additional capital transactions, the capital account will show a credit balance of 20,000 rupees. So, total credit is equal to 20,000 rupees. Total debit is equal to nil. Therefore, the balance of 20,000 rupees is written on the debit side as to balance carried down. In the next accounting period, it appears on the credit side as by balance brought down. Financial statement position. The balance of the capital account appears on the liabilities side of the balance sheet because it represents the owner's claim on the business. Purchase account. Total purchases, 4,000 rupees plus 4,000 rupees is equal to 8,000 rupees. Purchase is a nominal account, therefore, it is not carried forward. It is closed by transferring to the trading account. No balance brought down appears in the next period. This ensures that expenses are matched with the revenue of the same period. YS account, nature, personal account creditor. Total credit purchases is equal to 8,000 rupees. Total cash paid is equal to 4,000 rupees. Balance payable is equal to 4,000 rupees. Since the credit side is greater, 4,000 rupees is written on the debit side as to balance carried down. In the next period, it appears on the credit side as by balance brought down. This balance appears under current liabilities in the balance sheet. ZS account, nature, personal account debtor. Total credit sales is equal to 8,000 rupees. Total cash received is equal to 8,000 rupees. Both sides are equal. Therefore, no balance is carried down. This indicates that the debtor has fully settled his account. Sales account, nature, nominal account income. Total sales, 4,000 rupees plus 4,000 rupees is equal to 8,000 rupees. Sales is a nominal account and is closed by transferring to the trading account. No balance is carried forward. Conceptual connection between ledger and final accounts. Cash account appears in the balance sheet. YS account appears under current liabilities. ZS account would appear under current assets if a balance exists. Purchase and sales accounts are used to calculate gross profit in the trading account. Ledger balances are used to prepare the trial balance. The trial balance ensures arithmetic accuracy. Final accounts determine profit or loss and financial position. Thus, classification forms the bridge between the journal and financial statements. Conclusion. Classification is a vital stage in accounting because it organizes transactions systematically and enables the determination of account balances. Real and personal accounts are carried forward to maintain continuity of assets and liabilities. Nominal accounts are closed to determine profit or loss for the period. A proper understanding of ledger posting and balancing strengthens the foundation of accounting and ensures the accurate preparation of financial statements at school level, higher secondary level, degree and post-graduation level.